You built an 800-plus credit score that took you years of discipline. No missed payments, no late fees. You followed every rule they said would open doors, and you still walk in and pay more. Not because you did anything wrong, but because the system doesn't treat Black households the same way, and here's why. Freddie Mac pulled data on millions of mortgage applications across this country. Their own numbers showed that Black borrowers with excellent credit scores, above 760, were being offered worse rates than white borrowers with scores that were genuinely lower. So the question is not whether your credit is good enough. The question is whether this system was ever designed to treat it the same, and what that gap has been quietly pulling out of your family's wealth month by month, house by house, generation by generation. That's exactly what we're breaking down today. With real numbers, no theory. Real quick, if nobody in your life is having this conversation with you about money. Profit Plot exists for exactly this reason. We don't soften the data. We don't skip the uncomfortable parts. We just give you the full picture so you can actually move with it. Hit subscribe right now. Hit the notification bell. And let's get into this. In 1989, the FICO score arrived with a specific claim attached to it. The claim was fairness. Before the credit score existed, a loan officer sitting across the table from you held enormous personal discretion. Whether you got approved, what rate you were offered, how they treated your application, that all lived inside the judgment of one person. And judgment, as anyone who has lived in this country long enough already knows, was not being applied evenly. So the credit score was positioned as the solution, a single objective number that stripped the human out of the decision. No more gut feelings, no more, I don't know about this one. Just data, just the score, just math that didn't know what you looked like or where you came from. And for a lot of Black families, that sounded like a door finally cracking open. So they committed to it, fully. They became meticulous about their credit in ways that their counterparts never needed to be. They tracked utilization. They kept balances low. They paid ahead of schedule. They built files that were, by every technical measure, excellent. They earned 740, 760, 800s, and then something quietly wrong happened in the data. The numbers were there. The scores were strong, but the offers coming back from lenders weren't matching what those scores were supposed to guarantee. Rates were higher than expected. Terms were tighter than they should have been. And the families who had done everything right were still somehow walking out of banks with deals that felt off, even if they couldn't immediately prove why. The credit score didn't remove bias from the system. In many cases, it just made the bias harder to see. Let's talk numbers, because this is where the conversation stops being emotional and starts being undeniable. In 2021, the Markup conducted one of the most detailed analyses of Home Mortgage Disclosure Act data ever published. They controlled for income. They controlled the loan amount. They controlled the neighborhood. They controlled for debt-to-income ratios. This was a serious, peer-reviewed methodology, not a think piece, not a blog post. Their finding: Black applicants were 80% more likely to be denied a conventional mortgage than white applicants with comparable financial profiles. 80%. That's not a blip in the data. That's a structural pattern showing up consistently across institution after institution. But here's the part that often gets skipped over in the headline, because the denial story is dramatic. But it's actually not the most expensive story. The more expensive story is what happens to the people who get approved. Freddie Mac's own research showed that Black borrowers who received only one rate quote, meaning they didn't aggressively shop for competing offers, were consistently offered higher rates than white borrowers with comparable credit profiles. Not sometimes, consistently. And the National Bureau of Economic Research published a paper quantifying the average premium. Black mortgage borrowers paid approximately 0.29 percentage points more in interest than similarly qualified white borrowers. Some studies have found that number higher. None have found it lower. Not one piece of serious research has looked at this question and concluded the gap doesn't exist. A quarter to a third of a percentage point sounds like nothing. It sounds like the kind of decimal that only matters to actuaries. What it actually does to a family's wealth over 30 years is something entirely different. And we're going to do that math precisely right after we understand why this is happening in the first place. The reason this conversation is difficult is that most people picture discrimination as something obvious: a door slammed, a form stamped denied, with no reason given, somebody saying something they shouldn't. What's actually happening in lending is more embedded than that, and harder to point to in any single transaction. There are three mechanisms driving this gap, and understanding them changes how you walk into every financial institution for the rest of your life. Mechanism 1. The algorithm sees your zip code. Modern mortgage underwriting runs through automated systems. These systems analyze your income, your debt, your credit history, your assets. They don't see your race explicitly, but they see your zip code. They see property value trends in your specific census tract. They see historical default rates by neighborhood. They're built on data that stretches back through decades of American housing policy. And here's the problem with that. American zip codes are among the most racially segregated data points that exist, redlining the federal government's explicit policy of refusing to insure mortgages in black neighborhoods that ran from the 1930s through the 1960s, drew literal lines around communities, and cut them off from the wealth-building infrastructure everyone else could access. Those geographic boundaries didn't disappear when the policy ended. The wealth gap they created compounded. And today, the algorithm trained on American housing data is, in many cases, using zip code as a proxy for risk in ways that track closely with race without any individual person in the process having to make a discriminatory decision. This is what researchers call proxy discrimination. The variable isn't race, it just correlates with race so tightly because of how this country was structured that the output reflects it anyway. Mechanism 2. The room where discretion lives. Not everything about loan pricing is automated. Many lending institutions allow loan officers a pricing range within which they can adjust rates and fees. They're not choosing numbers from thin air. There are guidelines, but within those guidelines, there is human discretion. A Department of Justice investigation found that multiple major lenders had allowed loan officers to charge Black and Latino borrowers higher discretionary fees that were technically within policy, but that fell disproportionately on borrowers of color. No individual loan officer necessarily set out to discriminate. The policy created the room. The room, exercised across tens of thousands of transactions, created the pattern. This is exactly why individual cases are so difficult to challenge. Any single decision can be justified on paper, but when you look at 50,000 loans from the same institution and the pricing pattern is consistent, coincidence runs out of runway. Mechanism 3. The down payment that history made harder. The third mechanism is the one rooted in something most financial conversations don't want to revisit. The Federal Reserve's Survey of Consumer Finances documents a persistent, significant gap between the median wealth of white families and black families in America. This is not contested data. It is the Federal Reserve's own tracking of its own economy. Because of that wealth gap, Black homebuyers are statistically less likely to be able to come to the table with a 20% down payment. And when your down payment falls below 20%, lenders require private mortgage insurance (PMI). PMI adds, on average, 0.5 to 1.5% to your effective monthly borrowing cost. So even when the stated rate on paper is identical, the family that couldn't arrive with the larger down payment, which is disproportionately the black family, because of wealth extraction that occurred under policies now illegal but never corrected, pays more every single month. The discrimination isn't always written into the rate sheet. Sometimes it's written into the compound effect of historical exclusion showing up in present-day bank calculations, and nobody at the closing table has to say anything at all. Now let's put real numbers on this, not approximations. Actual math. You are 30 years old. Your credit score is 775. Your income is stable. Your debt-to-income ratio is clean. You've done the work. You're financing a $350,000 home on a 30-year fixed mortgage. Your similarly qualified white colleague with the same loan amount, same income, same general financial profile gets offered a rate of 7.00%. You get 7.25%. That 0.25% premium, documented in the research. Here's what that looks like on paper. At 7.00% on $350,000 over 30 years, your monthly payment is $2,329. At 7.25% on $350,000 over 30 years, your monthly payment is $2,388. The difference, $59 a month. Call it $60 to keep the math clean. $60, the cost of 2 streaming subscriptions and a fast food run. Easy to dismiss, but here's what $60 a month means when it compounds across 30 years. $60 multiplied by 360 months equals $21,600 in extra total payments. You paid $21,600 more for the same house, same square footage, same walls, same neighborhood. The only variable was that quarter of a percentage point and what sits behind it in the data. But $21,600 is still not the real number, because that $60 a month wasn't just money you handed to the bank. It was money you couldn't invest. If instead of paying that $60 extra, you had directed it into a diversified index fund earning the S&P 500's long-run historical average of 8% annually compounded monthly every month. For 30 years, here is what it becomes. $89,500, nearly $90,000 in wealth, sitting in your investment account, growing, working for your retirement, funding your children's future. That's what the rate premium extracted from your family, not through anything dramatic, not through a robbery, through a quarter of a percentage point on a document most people sign without fully understanding. Now add the generational dimension. Your mortgage ends when you're 60. If that $89,500 had continued to grow in a portfolio at 8% annually for another 10 years, the window it would need to reach your children, it becomes $89,500 times 1.08 to the power of 10 equals $89,500 times 2.159 equals $193,230. Nearly $200,000. Gone from your family tree, not from one catastrophic decision, from one quarter of a point that most people never thought to challenge. And we're talking about one house, one loan, one family. The mortgage is the biggest number, but it's not the only place this premium shows up. Auto loans. The National Fair Housing Alliance analyzed auto lending data and found that Black borrowers were charged higher dealer markup rates than white borrowers with similar credit profiles. On a $40,000 vehicle loan financed over 60 months, a 1.5% rate premium costs approximately $1,620 more over the life of that loan. Finance 5 or 6 vehicles over a lifetime of driving, which is realistic for most adults, and you're looking at roughly $8,000 to $10,000 extracted in rate premiums on transportation alone, on cars that were depreciating the entire time they were being financed. Small business lending. A Federal Reserve report documented that Black business owners were approved for small business financing at significantly lower rates than white business owners, even when controlling for revenue, credit score, and years in business. And when they were approved, the terms were consistently less favorable. For an entrepreneur trying to hire, expand, or take on contracts that require working capital, access to affordable credit is not a soft advantage. It's the mechanism that determines whether a business scales or permanently stalls. The premium isn't in one corner of the financial system. It moves with you: mortgages, car loans, business financing, and in some studies, credit card pricing. Everywhere that risk is being assessed, the data shows Black borrowers paying rates that do not accurately reflect their actual risk levels. A 780 credit score is supposed to mean something precise. The data says that meaning isn't being applied consistently. Understanding that a system is working against you is not a reason to stop playing. It's a reason to play smarter and harder than the system expects you to. Here is what the research and the data actually point to as effective moves. Shop until you have real competition. The rate the first lender quotes you is not the rate you have to accept. CFPB research consistently shows that borrowers who collect multiple competing offers save money, and the savings are proportionally larger for Black and Latino borrowers than for white borrowers, precisely because the opening offers tend to be more inflated. Get at least 3 quotes. Get 5 if you can, from different types of institutions: traditional banks, credit unions, online lenders, community development financial institutions. The spread between your worst and best offer on the same loan can be hundreds of dollars a month. The same Freddie Mac study that documented the disparity in single quote scenarios showed that borrowers who received 5 or more quotes narrowed the gap significantly compared to those who accepted the first offer without pushing back. Negotiate with a number in your hand, not a feeling. Can you do better? Is a weak negotiating position. I've been offered 6.875% at a competing institution. Can you match or beat that? Is a specific target that forces a response. Bring competing offers in writing. Loan officers have more discretion than they often reveal and use a concrete number to access it. Prioritize credit unions. Studies consistently show that credit unions, member-owned cooperatives, rather than profit-extracting corporations, offer more equitable pricing to borrowers of color. They're not immune to bias, but their structural incentive is different. They're not trying to maximize the spread on each individual transaction. They're serving a membership. That difference in incentive shows up in the data. Build your file to make discretion irrelevant. The premium that discretionary pricing authority creates is harder to apply when your file leaves no room for ambiguity. Maximum credit score. Years of on-time payment history across multiple credit types. Clean documented income. Cash reserves clearly verified. The goal is to make the case for the best rate so airtight that adding a markup becomes difficult to internally justify, even for a system that would otherwise reach for it. Document. Escalate, don't drop it. If a rate you're offered feels inconsistent with your profile, request the specific factors that produced it in writing. Compare it against published data on what similarly qualified borrowers receive. The Consumer Financial Protection Bureau accepts fair lending complaints. The Department of Justice has prosecuted cases against lenders whose data showed systematic pricing disparities across race lines. Individual complaints rarely move institutions on their own, but documented patterns, reported consistently, are what have historically forced lenders to change what they cannot be forced to explain publicly. I want to close with the larger frame because some people hear racial discrimination in lending, and they categorize it as a social justice topic. Let me be precise about what it actually is. It is a wealth math problem. The racial wealth gap in the United States, the gap between the median wealth of white households and black households, has not materially closed in decades. The Federal Reserve's own data shows white families hold, on average, approximately 8 times the wealth of black families. That gap has historical roots that are well documented, but it is also being sustained right now through the mechanisms we just walked through. Every $89,000 pulled from a black family through a mortgage rate premium is $89,000 that is not compounding in an investment account, not being passed to the next generation, not being deployed into a business, not building community economic power. The wealth gap does not maintain itself through inertia. It is maintained in part by systems that price risk using factors that proxy for race systems that are sophisticated enough to avoid any single transaction looking like discrimination while producing discriminatory outcomes in aggregate. Understanding this clearly is not about victimhood. It's the opposite of that. The families building generational wealth in spite of this system are the ones who see it for exactly what it is, adjust for it, fight for every basis point, refuse to accept the first number as though it were final, and build financial files that are impossible to dismiss. The credit score was marketed as the great equalizer. For some borrowers, it has functioned that way. For too many black families, it has been a necessary but insufficient tool inside a system that found other ways to charge more. Knowing that, with this level of specificity, changes how you move. And that's the only reason Profit Plot exists, to make sure you're moving with the full picture. Think about someone you know who is about to apply for a mortgage, someone buying their first house, someone refinancing, someone who built that credit score the hard way and is about to walk into a bank trusting that the number speaks for itself. Send this to them right now, before they sign anything. Not as a warning that paralyzes information that arms, because the difference between knowing this, going in, and not knowing It could literally be six figures across a 30-year loan. If Profit Plot is your kind of channel, real numbers, real mechanisms, conversations that don't get watered down, subscribe and come back for the next one. We're building something here that's worth being part of. Go share it. I'll see you next video.